Human labor is raw energy. To preserve that energy for the future, humans invented a container, a conceptual tool used as a store of value. 10,000 years ago, that container took exceptional form, a sharp spear or a basket of fish. Over time, it abstracted into items like these cowrie shells, used by our ancestors to trade across entire continents. Modern representations of wealth have moved further away from physical reality, existing now as rectangles of plastic and encrypted bits of digital data routed over global networks. Money operates as a social technology used to coordinate human effort. Understanding how that technology functions is a requirement for navigating modern life. Wealth is entirely relative. A person earning the median household income in the United States resides in the top 1% of global earners. Regardless of one's relative position, capital serves specific functions. The first is covering the non-negotiable baseline of food, clothing, and shelter. The second is funding aspirational needs, such as property or education. The third function is achieving financial independence, removing reliance on external subsidies. The fourth is creating a self-sustaining retirement that prevents an individual from becoming a financial burden to their children. These four goals provide a framework for personal freedom. Securing them allows a person to pursue their ambitions with minimal concern for monetary constraints. Two men spend a day chopping wood. One works nonstop. The other takes frequent breaks, yet manages to chop more wood. He achieved a higher output because he used his breaks to sharpen his axe. To sharpen your financial axe, start with a quantifiable target. Take your current age, multiply it by your annual pre-tax income, and divide the total by 10. This provides your baseline target net worth. Reaching this target involves dividing your timeline into distinct horizons: short-term goals for the next 2 years, medium-term deployments for 2 to 5 years, and long-term accumulation plans extending beyond 5 years. Reducing your future to a mathematical target provides a concrete roadmap. It replaces vague financial desires with an actionable plan for capital allocation. Storing capital in a vault does not protect it. A constant force of mathematical decay, called inflation, continuously raises the cost of goods and erodes purchasing power. During the 1923 Weimar hyperinflation crisis in Germany, this decay accelerated to an extreme. Printed currency lost its value so rapidly that bricks of cash were given to children to use as building blocks. To meet reparations without foreign currency, the government printed money until a single note represented millions of marks. This effectively wiped out the savings of the entire population. Real returns are what remain after subtracting inflation and taxes. From 2004 to 2014, bank fixed deposits returned 7.8% against 8.4% inflation, causing a net loss. Meanwhile, equity mutual funds returned 20.9%, providing true growth. Static saving leads to a loss of value over time. Maintaining a standard of living requires deploying capital into vehicles that consistently outperform the rate of inflation. Capturing that capital requires operating with the discipline of a CEO. The Lee Kashing model suggests allocating 30% to living expenses, 20% to networking, 15% to learning, 10% to travel, and 25% to investing. Relying on a single salary creates a point of failure in this budget. Accelerating your investment rate often requires secondary income streams, such as leasing property or operating a side business in your spare time. Invested capital is subjected to exponential compounding. If you place 1 grain of rice on a chessboard and double it every square, the final square requires an amount larger than Mount Everest. Money earns interest on its own interest in this same progression. For a 23-year-old with an 800,000 rupee salary, investing 20% of their income at a 12% return results in over 9 million rupees by age 35. Consistent capital allocation turns time into a multiplying force. It is the threshold where an individual stops working for money and allows the money to work for them. Successful allocation depends on identifying true assets. An asset puts money into your pocket through income or appreciation. A liability takes money out of your pocket. Standard accounting labels your residence and vehicle as assets. However, for a wealth builder, these function as cash flow liabilities. They demand continuous maintenance and taxes, frequently depreciating in value over time. True assets generate yield with minimal ongoing labor. These include dividend-paying stocks,
interest-paying bonds, and rental real estate that provides a steady stream of passive income.
The wealthy focus on acquiring income-generating assets. The middle class often accumulate depreciating liabilities that are structurally disguised as assets. Efficient portfolio design relies on three interconnected pillars. To manage wealth successfully, you must coordinate the Wealth Trinity: risk, return, and time. In 400 BCE, Gujarati merchants sailed primitive wooden ships to Southeast Asia. They accepted extreme risk, from pirates to shipwrecks, because a successful voyage yielded a 2,000 times return on capital. Risk is the cost of participation in the market. Returns can be misleading. If an illiquid real estate investment doubles in value over 10 years, the absolute return is 100%. However, when measured by the timeline, the annualized return is only 7%. Time serves to mitigate these risks. While a one-year investment carries a 27% probability of loss, holding the same portfolio for 15 years reduces the probability of a negative return to zero. Market volatility characterizes every long-term economic cycle. It presents a fatal risk only to those who lack the time horizon to outlast the downturn. Protection against volatility comes from precise asset allocation. Just as a balanced diet mixes proteins and carbohydrates, a diversified portfolio ensures that when one asset class drops, uncorrelated assets provide stability. Liquid assets are divided into two primary categories. Publicly listed equities represent partial ownership in corporations, while fixed income schemes act as debt instruments. Historical data reveals the limitations of fixed income. With average yields ranging between 6.9% and 8.4%, these instruments consistently struggle to outpace the combined pressure of inflation and taxes. To decouple from public market trends, investors use alternative assets. Venture capital, hedge funds, and physical art offer uncorrelated returns, acting as a structural hedge during equity market corrections. Fixed income is a tool for short-term preservation. Building wealth over decades involves a significant allocation to equities and alternative assets. Success requires psychological discipline. It involves continuous education and the ability to block out the noise of the daily news cycle. The Marwari business community relies on specific operational rituals, strictly monitoring cash flow, verifying delegated results, and ignoring temporary market fads in favor of proven systems. Entrepreneurship serves as a primary driver of high net worth. 59% of individuals in the top tier of wealth globally generated their capital by building and operating their own businesses. Whether managing an enterprise or a personal portfolio, the rule remains the same. You must track your performance. What cannot be measured cannot be controlled. Money, compounding interest, and asset allocation act as interlocking mechanical tools.